Welcome to the SeizeYourBusiness.com podcast. I'm your host, Kevin O'Flaherty from O'Flaherty Law. I'm joined by my co-host, Jim Wazak from Success Enhancement. And our guest today is Bill Graham from Turnbridge Consulting Group. And our topic is going to be, what is your business worth? So thanks for joining us today, Bill.
My pleasure.
So tell us a little bit about your background.
Okay, well, it wasn't a straight line, let me put it to you that way. I early on got a degree in industrial organization psychology, so did a lot of training, team building, that sort of thing with actually large corporations. So after being a hired hand for a few years and getting fired a few times, I decided that wasn't the way I wanted to go. So, then I got into being an educator, teacher for a lot of years.
What did you teach again?
Everything from statistics to psychology to business planning to a lot of different things.
What level?
This would have been 2 to 4 year college, a couple graduate courses.
Okay. Oh, wow.
Yeah.
Okay.
Did that for a bunch of years and owned a couple businesses. Deli, owned something you never want to own is a limousine business, especially with Uber coming along. And then had a consulting business for a lot of years, still do.
Okay.
So business consulting. So in that, we help folks with their business plan. We help them kind of look at their business and see if they have what particular directions they want to go. And a piece of that, of course, we recommend for their planning is, eventual either acquisition or disposition of their business. And I think a lot of people don't do that, of course, when they start out, and then they begin to say, well, at some point, what am I going to do? In what ways will I phase out of this business?
Sure.
Well, the question that, a lot of business owners want to know is, what's my business worth, And I'll tell you from my life experience, I used to buy things for the company I worked at. I was CFO. I used to buy and sell collector cars. I bought real estate. But it seems to me like while everybody thinks their item is worth a lot more than what it's really worth, no more so than the business owner.
Sure.
So, what are the different ways a business might be valued? What things you look at? And maybe you also comment a little bit about the emotional state of the owner.
Sounds good, yeah. I think in some respects you ought to look at that emotional state in the first place. Typically, what we deal with is primarily businesses that are either family-run or they're small partnerships. We don't get into much of the corporate aspect of it or divisions of corporate. We've got burned a couple times doing that ourselves. The bottom line is, especially when you're talking about a personal ownership of a business, they've had their blood, sweat, and tears in the business. There's no doubt about that if they've had it for any length of time. And a challenge, you can go with numbers like what's the value in terms of EBITDA, or what's the value net and a seller's discretionary earnings if you want to make it more personal.
Can you explain both of those things?
Yeah. EBITDA is more like earnings before interest, debt, and taxes. So that's a kind of a net figure, usually done in a corporate setting or at least with a corporation. And that's done, it comes from IRS rules, but essentially people do look at that in terms of what they might pay for a business because they say, well, okay, this is what this person actually gets as boil it all down, that's what they get. If it's in a corporate setting, then it's more complex, but still it's the bottom line. Now, in terms of seller's discretionary earnings, it's a difference that I think if you're just talking about the corporate world, that wouldn't come up because discretionary earnings means that, hey, the owner can say, well, that car I bought or that piece of equipment I bought, I can use that in a lot of different ways. I'll use it for my business. A portion of it I probably would use personally, but I can pay for it out of the proceeds of the business. I can write it off in a certain rate, percentage-wise.
Sure.
IRS is all happy with that. But then they have the use of that vehicle, the use of the equipment, the use of the internet, whatever they're charging against the business.
Right.
The difference in those numbers can be substantial if it's a small business. So you've got a business that's making a couple $100,000 a year gross, and you boil it all down, take out all expenses and all that sort of thing, and the owner sees perhaps $70,000, $80,000. Well, if they also include that 2-year-old car that they bought or the 2-year-old van that they bought but they still get around with, that can actually bump up quite a bit of what their earnings are because they're not paying for it after they earn the money.
Correct.
So that does factor in what the value of the business is.
Is it typically a multiple of 3 of either EBITDA or the seller's discretionary income?
Well, I mean, you can say that's a rule of thumb, and oftentimes, especially small businesses, they look at that and say, yeah, it's somewhere 2 or 3 times. But again, it depends on the kind of business. If it's a very capital intensive business, and we deal with some of those like quarries or landfills, then you've got a lot of equipment involved there that took a long time to acquire, and it's written off at a certain rate. So that has to be factored in, because a certain amount of that money that comes in the front door, has to go to pay those things. But there's value involved in it, those assets.
So you want to include the assets in your calculation in addition to the income, obviously.
Yeah. And the more capital intensive you got, the more stuff, then the more assets you have. And that's especially difficult if you're trying to value a business that has land attached to it.
Mm-hmm.
And we've dealt with a lot of those. I mean, it could even be just a small salon, but they have a storefront, or they own the building. And maybe the building is actually worth more than the actual net of the business. Now, they have some choices about that. They could try to sell the building with the rest of the business. A lot of them look at that and say, well, that's going to add to what I take in my gross payment when I, cash out, so to speak. IRS loves that. They love to tax as much as they can. So oftentimes business owners will say, I'll tell you what, Mr. Buyer, I'm going to sell you the business, but I'm going to retain that piece of property, that asset. I can rent it to you, and I'll rent it to you at a fair rate. That way, that's a nice little piece of income for me when I retire. And it can be maintained and so on. Actually, a triple net, the buyer and the renter have to maintain it pretty much. So it's a nice piece of investable asset that garners something.
You make me think of a situation, and I'd like to hear your comment on this. But this particular case, I know this individual owns a motorcycle shop. Okay, he buys and sells motorcycles, does a little bit of repair work. Now, this guy, he's pretty amazing, because when he looks at something to buy, he doesn't look in any guidebooks or anything. He just, that's worth so much, and he's remarkably right most of the time. So he's been doing this for years, makes a good living at it, thinking about selling it. But, it's almost like he is the business.
Yes.
Without him, I mean, what does an owner like that do, or would you suggest they do to create some value for a buyer?
I think that's a real challenge when you're selling a small business, and that's maybe a single owner that has this business, and their knowledge base is a good part of the assets. It's not just goodwill, but it's knowledge is a part of the business. Now, there's some fairly direct ways to work through that. One that we always recommend to the buyer is, okay, that person is certainly a large portion of the business. They have the knowledge, the understanding of what it takes to make it in the business. You want to retain them for a while. It could be on a consulting contract. It could be that they essentially, the buyer would say, well, no, Mr. Seller, you have to maintain some skin in the game. You've got to keep a certain percentage of this business, which might work out just fine, because as the business grows, that seller, of course, is going to garner additional income that it wouldn't normally. So obviously in this situation, the buyer should be pretty smart about it. And it also kind of spreads out the payments, so to speak. So let's say we went with your number, 3 times net earnings, the net earnings, which say $50,000. And 3 times 150,000 would be the value of the business. It's a plumbing business. And the plumber there knows a whole lot about, putting in plumbing of all sorts and being able to do it on time and making a profit at it.
Right.
And he's a small business. He may have one helper and maybe a secretary part-time taking care of the bills and that sort of thing. Actually, we've had a couple businesses like that where we sold. The challenge then, of course, is to this buyer: are we going to keep that plumber on, or perhaps the buyer already has a number of facilities. He's got lots of plumbers. He doesn't need a lot of that knowledge. The challenge then, of course, is how do you value that knowledge versus goodwill, versus the fact that most of the customers that plumber have probably been coming to him or asking him to come over for 10, 20, 30 years, whatever it is.
Sure.
Those things are intangibles. They're not easy to, figure. So to get some idea, you usually go to the market and you ask around, at least the M&A person, the broker asks around, and you can do it electronically. You can do it by actually going out and polling similar businesses in the area. A lot of that's been done already. Things like Dunn's Review and so on. There are compilations of the values of businesses where they come up with these, rules of thumb for those kind of businesses. So what's
so it's almost like a Kelly's Blue Book for your business. You can
like
find or in the real estate market, you find something similar that's sold and use that as a basis.
So they call it comps, similar kinds of businesses that are for sale at a level. Now, the advantage of a business broker, and this is the kind of thing you were asking up front, how is that person going to find the information? Well, we're sort of linked in just like real estate brokers are. They have the MLS. We have a number of listings that show what businesses are selling for up to the minute that we can poll, and we can do a quick and dirty analysis. Now, if you want to get into more detail, then you usually do some sort of long-term analysis over, say, 10, 20 or more years with, net present value. And those are calculations that are actually, you can get them, in Excel anymore.
Sure,
it's not like they're not magic.
Right.
The challenge is that you're working with numbers. It's an approximation. It's an estimate. Something that we do not hang our hat on as a business broker, at least our group doesn't. If someone, let's say a seller, wants to know very exactly what they are, then we refer them to, an analyst, someone who does appraisals of businesses, and they've had a lot of experience doing that. It's not our forte, but we certainly know some appraisers that will do that for us if that's what the seller wants.
So they're doing a more advanced, basically, version of what you're talking about, I've never understood the difference between the informal business appraisal that you do and the official $10,000 to $15,000 business appraisal
or more.
that people dread having to do.
Yeah.
What are the different tools? Where does the real difference come in between having you just give your best guess based on your experience versus hiring a someone really expensive to do it?
Well, I think the appraiser, that person is worth his or her salt. If they've been in the business a while, they've done a lot of these. So it's a focus. It's more like a specialty, if you will. Some of them may also be business brokers. But the key in that is that they've done this so many times. It's almost like they know what to expect in terms of businesses. So now, as a business broker, we also specialize in certain kinds of businesses. As I already mentioned, we specialize in family-owned businesses and small partnerships. So we'll know more about that field than maybe some other business brokers that concentrate on, say, engineering firms or some forms of industrial firms. So again, it's a matter of degree, I guess is what I'm saying. There's no clear cut, okay, this is an appraiser and they know this, and this is the business broker and they know that. There's certainly a lot of overlap. What we do, though, is we base it really on the market. So we're more front line in terms of that. We're looking at what's going on in the market the last 6 months, a year. The appraiser usually has a little bit higher level view. They're looking at what you would expect over time. So they're projecting out a little bit more than we would.
But yours sounds more realistic because the market is, it's where you've got to sell it. You've got to sell it in today's market. I guess the appraiser might say, over time it's worth X and it's worth less than that now, so hold on to it until the market changes. But if someone wants to just sell their business, it seems like, having you see what the market will bear is probably the best strategy, right?
Well, we try. I think the challenge there with seeing what the market will bear is that probably it depends on what's going on in the general economy. In the last 8 years, we've had pretty depressed economy. So what even a year before that period of time, a particular property might have sold for, or business would have sold for. An example would be we're working with a number of quarry owners, mining owners, and they look at their buddies who got out, in 2005, 2006, 2007, sold their business, let's say, for $10 million, and they've got a similar sized business, and the market basically won't even look at it for more than 3.
Mm-hmm.
So it's a vast change.
Timing,
timing is everything, of course. So, we have to deliver that tough news to them in a way. We say, look, here's what's selling now, here's what's going on, here's what offers we're getting for this kind of property. And then, are they willing to go ahead and put their business on the market? we try to be a little bit creative if we can and say, okay, you've got several aspects to your business, like your assets, like their knowledge, like your current customer list. Those are all important variables, and especially, where would you, if you're selling that kind of business, it's not movable. So you're based on those assets, but you can rent the assets. You can rent your customer list in a sense. You can take payments over time, in other words. So you may have a certain list price, and then with adding those additional things, that seller can get more income.
Well, what strikes me as one of the variables too is what is the buyer actually buying, in the sense that you think of a business. Okay, it makes some revenue, it has expenses, it makes X dollars. That's the business, right? But it could be a bigger company wants access to a specific market. It could be a location. It could be a technology that company can't. It could be the talent they have. So those things could put, the business could, for example, I'm a golfer, so a lot of golf courses are getting sold because they're worth more as a housing development, know.
Sure.
So a comment maybe that some owners could be thinking about, what am I actually selling here?
Well, I think to take that the next step that we've been talking about, what's the value within the business? How's it described, I guess you would say. And you're very, very accurate about that, in that the business may well have all those aspects. It has knowledge, it has the customer, good quality customer relations. I think what kind of goes on the side of the buyer, and what's the buyer looking for? You mentioned that there may be a corporate, they're a strategic purchase. They're going to, take over this particular area. They want to buy that business, and they'll pay a premium for that, to get access to that region. That makes a difference in terms of the way it's sold, obviously, and the way it's marketed. And we've been confronted with that in this tough market quite a bit. What we usually do is we sit down and have a real heart-to-heart with the seller and say, okay, we know what you want out of this business. Now here's what you want. Here's the market over here, way down here. There are some ways to enhance that. Maybe, in the case of a piece of property where you may have a corporate acquisition, maybe you want to make it sweeten the pot for that buyer, saying, okay, I'm going to sell this business, down here pretty much, but I want a little, trickle of money to go for the next 10, 20 years. I'll rent you the land. I'll be a consultant to you for X number of years.
Sure.
Much of my staff is my family. They've been in the business. They know what's going on. They've got good customer relations, all that stuff. We're essentially selling you some services, and we'll package it up in a price that's very attractive. So that's all part of the value of the business. It's not, one number that someone, pays at the closing and that's it. People walk away from it. That happens very rarely. We've done it, and I don't think it happens. It's not necessarily good for either case, because especially if that owner walks away and they take a lot of good customer relations with them, especially it's a small business. And they also take knowledge about how they survive when the times are lean. Another buyer wouldn't understand all that.
Right.
So we try to pitch to that buyer as much as possible. Look, you have this person who's the owner or their family. They'll pledge to be with you X number of months or years, whatever. You have to pay them an attractive price for that, but you get a considerable benefit. It essentially insures your business a little bit. So you're paying that insurance, so to speak.
Sure.
So, Bill, if someone wants to reach you for some help buying or selling a business, how could they get in touch with you?
Well, the easiest way is billgrams.com. That's the easiest way because it's my name. Our corporate is Turnbridge Financial Group and Turnbridge Consulting Group. So if they look up Turnbridge Consultants or Turnbridge Consulting Group, you'll find us on Google.
There's an S at the end of Bill Grams.
Bill Grams, people try to. I don't know who BillGram.com is. Or Yahoo.com. It's BillGrams@Yahoo.com.
Okay, great. Well, thanks so much for your time today.
I appreciate it.
And Jim, if someone wants to reach you,
if you need improv style training, if you need an MC or a spokesperson, I'm probably the guy to talk to. 630-272-3895. Just give me a call, Kevin.
If you need any legal services, we do just about everything. You can reach me at 630-324-6666. And you can go to seizeyourbusiness.com to view all of our, I think this is episode number 62, so we've got 62 episodes on there in both video and audio form, and you can download us on iTunes. So thanks so much for listening, and thanks for your information, Bill.
Thank you, Bill.